45 years, zero name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Hello, everybody, and thank you for logging on to our presentation this evening. Tonight we have an awesome topic, and we're excited to present it to you today, and that's beyond the deadline, essential tax moves to make before 2024 ends. I'm accompanied this evening by Tony Watson, and my name is Tassos Pathos. So just a few things about me. I've been a licensed realtor in the state of California now for a little over 6 years. I attended Cal State University Long Beach and graduated with my bachelor's in business administration. I have 2 years of direct property management experience with Marshall Reddick, where I spent a lot of time coordinating maintenance, leasing property, and really working on all aspects of property management. Our portfolio ranged from single family homes up to about 30 units. I have a few fun hobbies. I'm a student pilot working on getting my private pilot's license. I'm a Husky owner. And I love to play basketball. I try to make it out there at least 2 to 3 times a week. I have completed real estate transactions in California, Texas, and Tennessee. And I'm also an investor here at our Marshall Reddick Mortgage Fund. So the topics that we'll be going over today are specifically related to taxes, and that's why Tony Watson is here with us today. So just a couple of bullet points for you guys to expect, a little synopsis right before. We're going to be going over year-end tax strategies. We're going to be going over W-4 withholding optimization. We're going to demystify mortgage interest deductibility. We're going to be mastering estimated tax payments, going over retirement planning, and navigating new BOI reporting requirements. So what we expect from you guys as attendees today is that we hope you take something from the topics we're going over. Please feel free to take notes. If at any time during the webinar you have a question, please type it in the chat and we'll make sure to have it answered for you, okay? Be ready to write any links that may come up during the presentation, and then please always remember that a recording of the presentation along with the slides will be sent out 24 hours within its completion. So we will have all this information ready to go for you guys, okay? Some of you may be familiar with Marshall Reddick, but we have some other attendees just being introduced with us. So I'm just going to break down who we are. So we are a full service real estate brokerage. And that's our first division. We help people buy and sell their homes as well as investment property nationwide. We did about 600 transactions, and we manage about 90% of those transactions at this point. Brings us over to our second division, and that's the property management division. So we take care of everything for the landlord, from leasing to maintenance, renovations, rent collections, and so much more, so that all the landlord needs to do is collect a monthly rent check. Our third division is our private money lending. Sometimes when you can't qualify for conventional financing, you need to secure private financing. So Marshall Reddick provides non-owner occupied real estate loans to borrowers doing either fix and flips, looking into new construction, or purchasing investment property. And then our fourth division is our mortgage investing, right? So the same way you can own real estate and collect rent checks, our investors own mortgages and collect the mortgage payments. So I personally invest in our Marshall Reddick Mortgage Fund, and I collect a quarterly distribution. This is our Marshall Reddick national footprint. So currently we're in California, Texas, Tennessee, up into Kentucky, and in Florida. We're broadcasting live today. Tony is in his office, and I am in the Newport Beach office. These footprints are, and these offices are selected in some of the best real estate markets, whether that be related to appreciation or just opportunities where we can find cash flow in properties. So we hand select these markets, and we really, really go into pushing investment properties into these markets because they really pencil out well for our investors. Love this slide. This is the team that makes it all happen. So this is a healthy mix of property management, realtors, our software team, our accounting team, and these are the people who are behind Marshall Reddick, making it run and operate every day. So at the top left, we have our new Braunfels office in Texas. Awesome office. You can see that big blue sign from the freeway. It's a huge sign, the I-35 that connects all three of our offices. On the top right, we have our San Antonio office. Bottom left, we have our Florida office. Right there in the middle on the bottom is our Newport Beach office. And then on the bottom right, we have our Tennessee team. Super cool. Okay, and this is going to lead me into our introduction over to Tony. Tony is with Robert Hall, and they have been our preferred vendor since 2010. He's a renowned speaker on taxes for both business owners and property owners. He's married, he's a father of two, and we've had the privilege of referring hundreds of clients to him. He's a real estate investor, so he really walks the walk, and he's spoken at over 100 of our events. So I'm really excited to introduce him today. So Tony, take it away.
Yeah, thank you so much. Really appreciate Marshall Reddick's team having me back. It's always good speaking to like-minded individuals, and whether they're in-person or digital audiences, just filling the space with like-minded investors, people who want to educate themselves about the current codes, about past codes, about future codes. It just really brings me a lot of pleasure and I'm very pleased to see people taking time out of their schedules, especially with the World Series happening tonight. I am a diehard Dodger fan, grew up in Orange County myself. I'm very much a past Angels fan. I still love watching the Angels with my father. My parents still live in Orange County, but I've lived in LA for almost 20 years, and now I'm starting to bleed Dodger blue. So go Dodgers. Anyway, tonight we're going to talk quickly, not quickly, over the next 40 minutes or so about key tax moves to make it before 2024 ends. Obviously, we're sitting here, it's 5-6 days prior to the election. There will be lots of changes prior to year end. I'm hoping that most things that are implemented or changes will happen actually start as of January 1st of 2025. But I've been working in the industry for almost 20 years, so almost 2 decades. And I can tell you right now that the past elections that I've worked as a tax advisor, it never ceases to amaze me the things that the federal government, when I say the federal government, that they can make happen prior to the end of a calendar year, especially during an election year. So just be aware of that and keep yourself educated. Reach out to our office prior to year end, after the election, when you start to hear about a lot of the tax code changes for 2024 and on. Feel free to reach out because we do offer free consultations. I'll remind you about that towards the end of tonight's presentation. Robert Hall & Associates has been around since 1971. So I've been here for, once again, 2 decades. But Bob Hall has been up and operating since 1971 here in the Southern California area. We service around, actually right now, about 11,000 plus filings nationwide. So we do have clients in all 50 states. We've got great reviews online, so check us out at roberthalltaxes.com. And we've also been recognized in some local favorite accounting magazines and little trade journals. So once again, you could read more about us online. I don't know why my right arrows, there we go. We are much more than just a tax preparation office. We do offer incorporating services, we do internal auditing, we do bookkeeping services. I mean, you name it, we supply it. If we don't offer it under the roof here at Robert Hall & Associates in beautiful Southern California, Glendale, California, we have a list of vendors that we can refer you to. A lot of our vendors are the vendors that Marshall Reddick's team uses and refers to, so we keep it all in the family. And these are all people who we've vetted out and we've been working with for, most of them over a decade. So we have some great vendor referrals to connect you with. I by no means am a one-man operation. So when people say, well, can I send somebody over to talk to you? I say, sure, I'm open to talking to people unless I'm on a seminar circuit, right? So the goal here at Robert Hall & Associates is to service as many people as possible, to make sure they get the information as quickly and efficiently as possible. So I could not do what I do day in and day out with my team. We've got about 13 senior consultants on staff here. Our total staff with admin and everybody else, about 56 employees strong. And we need this kind of manpower and woman power to handle tax filings across the US, right? Roughly about 11,000 tax filings on an annual basis. So a little bit about me. Thank you for the intro, by the way. A little bit about me. I'm going on, once again, 2 decades of service with Robert Hall & Associates. I'm not only an active practitioner in the tax preparation world, but I am also the public speaker. My individual column ranges in the $500 million range in managed real estate and other small business dealings. So I do see a lot under my column, as well as the other senior consultants here. We're all kind of even keeled as far as valued clientele roster is concerned. We see a lot here. Full transparency, we see mostly real estate professionals in our office. So people who have passive and non-passive real estate investments, agents in the real estate field who are earning commissions, property rehabbers, flippers, the people who are obsessed with the Airbnb and VRBO models. We do handle a majority of our files in the real estate world, or most of them settle in the real estate world. I'd say about 65 to 70% of our clientele are real estate professionals and investors. And aside from tax preparation, I'm also the keynote speaker, speaking at over 140 plus events on average per year, most of them on the digital platform these days. Prior to the pandemic, we were doing almost every single seminar in our conference room upstairs. I'd make trips down to Newport Beach and speak at the physical location with Marshall Reddick. I'd take trips down to San Diego, San Francisco. But thank goodness for this digital platform that we have accessible at our fingertips nowadays, because you can sit at home, have the Dodger game on your TV, and also educate yourself about real estate investing. So I'm glad to be able to connect with you all tonight. I will mention this past slide. I'll mention it again towards the end, but we do offer free consultations, and I'll show you my contact info at the end. I want to get into the meat and potatoes tonight and not waste anybody's time here. I did need to mention our attorneys always require us to put this on the screen. I am not an attorney, so if you feel like you are receiving legal advice tonight, please always take whatever that information is that you're taking notes down on, take it to your attorney, double check on the legal side, because everything tonight is mainly from an income tax planning and advising perspective. Even though I might know the legal code because I've been doing this so long and I have attorneys that I work with very closely, I do not want to step out of my lane of expertise. So I do want to mention that. Anything on the legal side, absolutely double, triple, quadruple check with your preferred legal advisor. So without further ado, we are approaching year end. November 5th is the election. We've got a lot going on with business, winding down business before the end of 2024. There's a lot of unforeseen things that will be happening over the next 2 months. We've got the holidays coming up. I know that we try to crunch as much into our busy schedules as possible with Halloween, Thanksgiving, Christmas time, but I want to mention this, and I couldn't be more serious about this. Year-end planning is incredibly important for those of you who want to take a stronghold of your financial positions as we enter into 2025. A lot of people feel like when they come to their tax advisors, all we do is file your tax returns, and that is a small percentage of what we do here at Robert Hall & Associates. Yes, tax season is busy. We're working 18, 19, 20 hours some days, just trying to push through tax returns with the federal government and the state agencies. But a majority of what we do outside of tax season is planning and advising. And so why do people think that year-end planning is important to them? Why do I think it's important for me, for my business, and also for my clients? Well, when I ask them, when they're in my office or when we're on the phone, why do you think year-end planning is important? Why do you think we should talk prior to year-end? The number one answer or assumption is to avoid unnecessary penalties and interest. I would have to agree on that. Why waste money by paying the government more than what your obligation in tax is, right? You're just flushing money down the government drains at that point. So figure out a plan prior to the end of the year, figure out what needs to be prepaid by January 15th of next year, which is the end of the fourth quarter, to avoid unnecessary interest and penalties. Number two answer is to position myself in a better way, right? To figure out if I have the ability to fund a 401k or a self-directed IRA, if I need to go out and make or spend money to improve my property prior to year end to reduce my taxable cash flow, helping keep more of my money in my own bank account. So number two answer is usually about positioning power, right? To put yourself in that position to know, hey, I've done everything I possibly can prior to December 31st to help me keep my money in my bank account rather than, once again, flushing it down the government drains. Last but not least, the third answer is always peace of mind. This actually rings home for me because when I started with this in this industry about 19, 20 years ago, I realized something very quickly about Bob Hall's clients. He was my mentor for the first 2-3 years that I worked here, and that's right around the time that I met Marshall Reddick, the man Marshall Reddick, and realized that our firms would work very well together. We are all about peace of mind. We want to make sure that our clients are not heading into a surprise come tax filing time, right? No one likes surprises. When you go into your dentist's office and you sit down in that chair, the last thing you want to hear is that you're going to need a root canal, right? That's a surprise. Well, I've been brushing my teeth, I've been flossing, why do I need a root canal? Well, people get old, your teeth decay, it's just part of life, right? But it is a surprise. No one likes surprises. At least in the tax world, we can prepare you for whatever the bottom line result is, at least dialing it into maybe $100 delta from what is actually owed. And that gives you a lot of power prior to year end, right? If you come into our office in October, November, we sit down, we dial, we wind down the numbers, we figure out your year-to-date income, year-to-date expenses, and then we come up with this bottom line estimated liability, and then we send you back into the real world to reinvest your profit back into infrastructure, helping you reduce that bottom line liability. And the goal is to, once again, to help you retain wealth that you've built for yourself over the course of 365 days. Rather than waiting until Q1 of 2025, why don't we front load some 2025 expenses in the Q4 of 2024, help you reduce liability this year, free up some cash so that you have more cash available to invest in real estate, maybe do short-term loans, pump money into a 401k, once again, in turn, helping you retain a lot of that wealth that you built for yourself. So I really like number 3. Number 3 is actually number 1 for me personally, is peace of mind. I never like surprises when it comes to financial decisions, to financial, tax returns that are being filed, loan documents. I don't like being bothered at the 23rd hour, right? Days before we close, which even though years and years of buying and flipping and helping clients with real estate, I know that stuff happens, but you can put a plan in place to succeed with the results, right? Because what's that famous saying? Failing to plan is ultimately planning to fail. You want to put a plan in place for success, right? For the best overall results. And that's where year-end planning comes into play. So keep all of that in mind, even just setting aside 30 minutes to an hour prior to year-end. I know that a lot of us are busy, but just try to block out some time to at least hop on a call or a Zoom with your tax professional. A lot of people, when they come in for year-end planning, they say, well, Tony, do I have to make this prepayment? I'd rather keep my cash liquid, in the market as the election passes, the market recovery, maybe I can make some gains before year-end. I'd like to keep my cash liquid rather than prepaying the government, $50,000 to $100,000 or whatever your estimated tax payment is going to be. And I tell clients all the time, I said, listen, estimated tax payments, I don't want to say they're optional, but there is a way to calculate your estimated tax payments to make sure you're not overpaying and you're not underpaying. So this answer really all depends. Do you have to make estimated tax payments? Are you required to prepay your taxes? Well, why don't I give you what the code says, right? The code specifically states that if you are going to make a prepayment, let me go to the next slide. I don't know why it's freezing. There we go. If you are going to make a prepayment, we need to sit down and first off, do a W-4 review. For W-2 wage earners, this is a review of your exemptions on your paychecks to make sure that you're withholding enough, or if you are under withholding, let's go ahead and increase some of that withholding prior to year end so that you don't get hit with unnecessary penalties and interest come tax time. So that's a W-4 for the W-2 employee. A W-4 review for a self-employed individual, for a property investor, a real estate investor, we need to calculate 2 very, very unique numbers. We need to take a look at last year's liability and take 110% of that liability. And then we need to look at year-to-date income this year and calculate 90% of your projected liability for 2024. Whichever is less, and I'm sorry, this is not correct on the screen. It says whichever is greater. I keep meaning to correct that. It's actually whichever number is less. That is the required amount that you need to prepay by the end of Q4, which is January 15th of 2025 in this case. You need to prepay either 90% of the current year liability or 110% of last year's liability, whichever is less, in order to avoid unnecessary interest and penalties, estimate penalties, underpayment penalties, late filing penalties, and interest. The government would love to collect more than your actual obligation and liability because that's how the government makes money. We don't want the government to make any more money than they already make off of us, right? Because that's what the tax revenue is to go towards. That's how the government collects money and pays for all of the government subsidies that they tend to hand out, like a printing machine, it seems these days. But we want to sit down and we want to map out this calculation. And at that point, let's say that calculation is a number that you can't afford to pay prior to January 25th. Okay, we have other options. If you can't afford to pay, you want to keep your cash liquid, let's talk about what it takes to set up a payment plan. Can we set up a streamlined payment plan where you pay your liability over a 5-year period? Will that impact your credit score? How do we set that up with the government? Is there a charge for setting that up? There are other options of paying the government. If you have economic hardship and you can't afford to pay any of it, let's get in contact with the Taxpayers Advocate. It's a nonprofit organization that is under the federal government that will fight the federal government for your rights to not pay unnecessary tax, to not pay penalties. Once again, there are other options than just the 90% and 110%, but you wouldn't know about those options unless you worked with a licensed tax advisor. So keep all of that in mind. Once again, for employees, W-2 employees, it's a review of your payroll exemptions. For the self-employed individuals and the rental property owners and the property flippers, it's a wind down of your year-to-date and year-to-date income and year-to-date expenses. Imagine knowing what your bottom line liability is before year end is even up. All of a sudden, we come up with these unique calculations saying that, well, if things don't change, if things are very consistent through December 31st, your effective tax rate is going to be 32%, federal and state. And all of a sudden, on November 1st, let's say, you have that number in mind. Okay, I'm at the 32% bracket as it stands now. What if I spend more money prior to the end of the year? Well, knowing what your individual bracket is at any snapshot in time throughout the year gives you buying and purchase power, right? Because that essentially means that if I'm in the 32% bracket, any money that I spend for business purposes prior to year end is going to save me roughly about 30 to 32 cents on the dollar. So why not reinvest your profit back into your businesses, back into your properties, helping you reduce that liability, essentially getting a 30 to 32% discount on everything that you spend your money on. And at that point, it could help you increase revenue moving into Q1 of 2025. I call this a power position, also a power play. We at our office at Robert Hall & Associates, years ago, we coined this term called POP. POP stands for the power of planning, right? Failing to plan is ultimately planning to fail. So these are really unique and powerful positions for you as a business owner to put yourself in just to achieve the successful goal of paying your obligations tax and not a penny more than that obligated amount. So keep all of that in mind. All right, let's talk about some top tax deductions. I mean, I can spend probably 2 hours talking about each one of these deductions in totality, but I'm going to go through them quickly. And if you have independent questions about each deduction, I would highly suggest you set up a free consultation with one of our senior advisors to go more into detail about how these could apply on your tax returns. Number one deduction for self-employed individuals, for real estate investors, for realtors who are out there listing and selling properties. Number one deduction, not pre-pandemic, but starting in 2020 and coming out of the post-pandemic era, we've seen a lot more people investing or reinvesting profit back into marketing and advertising. Not only will this help you reach larger target market audience, revamping your websites, sending out new mailers and flyers. A lot of people are doing that again, by the way. They're doing door knocking again. Obviously, people aren't slamming doors in people's faces these days because they're not afraid of COVID. But this is a great deduction which will allow you not only the dollar for dollar reduction of taxable revenue by whatever dollar amount you invest in marketing and advertising, both on the federal and the state returns, by the way. But number two, it will actually increase your revenue in the long term, because you once again are reaching larger target market audiences. So marketing and advertising, great dollar for dollar federal and state tax write-off, number one in my book. Number two, professional supplies and equipment. I mean, how many people do you know in today's day and age who can do what they do professionally without a computer, without a cell phone, without a desk, without a chair, without a filing cabinet? All the stuff in my office here in Glendale, right? Great dollar for dollar adjustments to my taxable income if I was self-employed. I'm not self-employed, but if this was my business, if I owned Robert Hall, these would all be great dollar for dollar write-offs for me. These are the most common deductions under the Internal Revenue Code. In fact, in my almost 20-year career, I have yet to see an audit on a cell phone purchase. I have yet to see an audit on a laptop purchase. I've yet to see an audit on a desk purchase, a chair purchase, a filing cabinet purchase. So make sure that you are thinking about these things when you're out upgrading your equipment, when you're revamping your in-home office space, when you're buying things for your commercial space, like the couches and the entertainment centers, the flat screen TVs, the sports memorabilia that I get for free because one of my clients sends it to me. But if you're purchasing this stuff for your office space, these are great dollar for dollar office deductions. So professional supplies and equipment, great overall dollar for dollar adjustment in most cases. Oops, I think I skipped a slide. Number three, car and truck expenses. Like I said, I could spend probably an hour or two just on these deductions. This is kind of a rabbit hole slide because people will want to know the differences between purchasing, leasing, and if you're just looking for the mileage deduction or the actual auto expense deductions. There's a range of ways that you could attack this slide. I can tell you right now that during the pandemic, I saw more people trading in their vehicles and upgrading to heavier weight vehicles that weigh over 6,000 pounds, specifically because they wanted to take advantage of bonus depreciation on a new company asset, right? Tesla Model X's, Mercedes G-Wagons, Chrysler minivans. These assets weigh over 6,000 pounds. And during the pandemic, the federal government was allowing 100% bonus depreciation write-offs for vehicles that weighed over 6,000 pounds. That meant that my Tesla Model X that I paid 110 grand for, I don't think they're worth 110 grand, but people were paying 110 grand for it. That was allowing them $110,000 federal write-off in 2021. Then in 2022, after the Inflation Reduction Act was issued or introduced, the Biden administration started phasing this bonus depreciation out. So currently, it is no longer 100%. But prior to the end of this calendar year, prior to the end of 2024, if you go out and you purchase a company vehicle and it weighs over 6,000 pounds, you are still allowed 60% of the value of that vehicle as a dollar for dollar federal deduction. Now, California doesn't conform to this part of the code. But as you can imagine, California's tax rate is always going to be less than federal, right? In fact, I think the highest bracket on the state side, if you're a super high income earner, it can be up to 14.3%. But a majority of Californians, they fall in like the 6 to 8% bracket. So sure, if California doesn't allow that, you're losing what, a 6 to 8 cent on the dollar deduction or deductible benefit. But on the federal side, imagine this: if you're in the 25 to 28% plus bracket and you go out and you buy, let's just throw out a number, let's say $100,000 SUV, and you get a $60,000 federal tax write-off on that at a 25% tax rate or tax bracket. I mean, that's a pretty sizable tax savings benefit for you. And here's the kicker: it doesn't matter if you bought the car in January of this year or if you literally buy the car on December 31st. That's 60% bonus depreciation as long as it's titled and insured and acquired in the appropriate ways for business deduction purposes. That is a massive 60% adjustment to your taxable income, even if it's on December 31st. So I've seen clients literally, do year-end planning, and right towards the tail end of the year, December 30th, December 31st, a lot of dealerships are trying to get rid of old models of the vehicle. So they're discounting the price, the cost of the vehicle for the sale price. And people are buying these vehicles literally at the tail end of the year. If you are looking for a new vehicle, this is a great conversation to have with a tax advisor. I am not the tax advisor that's going to sit here and say, oh, you got a vehicle 2 years ago, it still runs perfect, you really love it, well, we should go out and buy a new vehicle. That's not me. I'm not going to send people out to spend money for unnecessary reasons. If you are already currently shopping for a new vehicle or looking to buy out your current leased vehicle, we need to have a conversation about how to acquire those vehicles in the appropriate way so we maximize the tax benefit on that end. If you're not looking to purchase or lease a vehicle, you're probably going to be looking for the mileage deduction as a write-off, which is roughly at about 63 to 65 cents per business mile as a deduction. If your actual auto expenses, like your tire replacements, your oil changes, your engine repair, if that all adds up to be greater than the mileage deduction, you have options to take one or the other. You cannot take both, though. You cannot take the mileage deduction and actual auto costs. I've seen preparers do that in the past. It's a little bit of an aggressive move. I'm not going to say it's going to throw up crazy red flags on your return, but you want to understand the differences between, what those deductions mean on your return, and that it's just not the Wild West where you could throw it all on your return and save tens of thousands of dollars in tax. You have to do it the appropriate way. You have to know your rights as a taxpayer, number one. Number two, what is available for you specifically. Just because your neighbor, your coworker, your family, your friend bought a vehicle and took a benefit for it doesn't necessarily mean that it's going to apply to you. Okay, everybody's tax scenario is different, everybody's tax situation is different, so the planning is always going to be different. But just you educating yourself on this, watching TikTok videos even. I'm not a big TikTok person, not a big YouTube video person. If I need to know how to rewire an electrical plug in my house, sure, I'll go to YouTube for a tutorial video. But when it comes to tax code, you have to be very careful about what you are seeing online. I love that people want to educate themselves, but a lot of what you hear online does not apply to everybody, okay? Some of the ideas might be there and the conversation might need to be had, But just because somebody on TikTok said it was possible doesn't mean that it's going to be possible for your individual scenario. Just keep all of that in mind. Spent a little bit longer on that slide than I wanted to, but if you have specific questions about purchasing, leasing, or actual auto costs versus mileage, have a free consultation with our office and we'll dial that in. Number 4, legal and professional fees. What you pay an advisor at Marshall Reddick, for instance, what you pay an advisor or a consultation fee at Robert Hill & Associates. These are all still great dollar for dollar write-offs if you are self-employed or if you are a real estate investor. If you just are a W-2 wage earner and you don't have property, you don't have businesses that you own, and you just have a W-2 income, legal and professional fees are no longer a federal tax write-off for you. They are still a tax deduction on the state return for you, but the federal government back in 2018 removed what is called the unreimbursed employee expense form. So therefore, the only people who are able to deduct their tax preparation fees, their consulting fees with Marshall Reddick, are the real estate investors and the small business owners. So just be aware that some people will be limited as far as this deduction is concerned. Others will still be allowed the full dollar for dollar adjustment. Last but not least, real estate property deductions, specifically pertaining to cost segregation and bonus depreciation. In 2023, cost segregation bonus depreciation was at 80%. It is now dropped to 60% in 2024. It is going to drop to 40% next year. Now, there is a bill that has passed the House, but has not passed the Senate yet to bring back 100% bonus depreciation. So I'm really hoping, I'm knocking on wood, praying to the tax gods that after November 5th, whether it's a Kamala presidency or a Trump presidency, that both sides see the importance of bringing back 100% bonus depreciation for cost segregation. This I consider to be a holy grail election for real estate investors. I actually have an example coming up in the upcoming slide, so I'm not going to go too much into detail about this. But imagine this. As a real estate investor, let's say I have crazy cash flow through my investments. I don't really want to buy any more properties because I have enough properties in my portfolio. I'm kind of tired of managing them myself. I really don't want to acquire more assets, but I need additional tax write-offs to offset cash flow. Imagine being able to reach forward into future years and take future year depreciation in 2024 to help pay less tax, free up more cash to diversify my retirement investments, diversify my stock market investments, maybe even to buy another property, but a managed property and not a self-managed property, right? The goal here is to utilize certain elections under the current tax code to help reduce liability, free up cash so that you have more cash to spend and invest and make more ROI, right? In real estate, in stock investing, day trading, long-term trading, it's all about ROI. And the ROI comes from having freed up cash available to invest. So let's talk in more detail about cost segregation and how that might apply to you. Back in 2021, I had a new client approach me. He had already prepared 2020, so this is a 2021 return that I'm preparing for this client. Client A, taxpayer A, this is a real life example, by the way. These are real numbers. We just blanked out the client's number, the client's name, and the client's social security number. Taxpayer A is an LADWP employee, not a real estate professional. So you can see that W-2 of $120,000 there, a little bit of interest income, a little bit of dividend income, some capital gain income. But then about 5 or 6 lines down from the top in the 2021 column, you see that $33,183 number. That is the cash flow that taxpayer A has on a 3-property portfolio with very low debt, and very little improvement costs. They're rent ready, doesn't really want to put a new kitchen in, no new appliances, did his vetting well, he has good tenants. This is a good cash flowing 3-property portfolio. Taxpayer A, in the first conversation I had with this gentleman, he said, I do not want to work for LADWP forever. I have a great pension there, but this is not my dream. I don't want to be a W-2 wage earner for very much longer. He's in his early 50s, and he wants to eventually retire and live off the cash flow from his real estate portfolio. And he says, well, Tony, I can't invest in more property if my cash flow is requiring me to pay or cut a check to the US government in the state of California. So at the moment, we just plugged in the numbers to get a bottom line. At the moment, in the first scenario, he was owing about $4,000 to the IRS and about $4,200 to the state of California. So $8,200 in tax. And he says, Tony, is there anything I can do to help further reduce this 33 grand cash flow, keep more of what's mine in my own pocket, and then eventually use that money to buy more real estate? Or am I just out of luck? Is this just is what it is? This is as good as it gets. And I said, well, even though you're not a real estate professional, cost segregation might actually benefit you. And he looks at me, he's like, well, what's cost segregation? He had never heard about it before. And rightfully so. This is the first time he had ever connected with a tax professional that works with a majority of real estate investors and knows the parts of the code. Our firm really is good about finding these special elections and figuring out if it applies to our clients. Doesn't apply to everybody, but we have to make sure that, hey, we'll run the calculation, see if there's a benefit here. And if there is, we'll move forward with it. If there's not, then we wait till next year, we do the analysis again. So I send his 3 property addresses off to Jeffrey Gann, who's our cost seg specialist. Jeffrey Gann kicks back the analysis and says, okay, out of these 3 properties that were acquired in 2020, 2021, and 2022, I'm sorry, 2019, 2020, and 2021, we can accelerate, this is per the analysis, we can accelerate $400,000 in depreciation on these buildings all in 2021. I said, that's great. But knowing in the back of my mind that taxpayer A is not a real estate professional, there will be limitations to what he can deduct out of that 400 grand. So I plugged the $400,000 in as what's called a 481A adjustment. Federal and state both allow this deduction on the return. And taxpayer A, because he's not a real estate professional and he makes over $100,000 in adjusted gross income, he will be allowed a portion of the $400,000 deduction. And whatever he's not allowed, he doesn't lose, he just doesn't use. It becomes part of something called an unallowed passive loss carry forward, and then carries forward into 2022. And whatever he doesn't use in 2022 carries forward to 2023. So we get a $400,000 adjustment, right? We put that on the return. Taxpayer A is allowed about a $45,000 deduction out of the 400 grand. $355,000 becomes unallowed and carries forward into 2022. But as you can see, that $45,000 adjustment dropped his 33 grand net cash flow into a loss of $11,549. Now, dropping his federal liability completely, now taxpayer A is looking at close to a $6,000 federal refund. And on the state side, no longer owes $42.87 to the state of California. He's looking at about a $1,400 state refund. It's about a 14 grand delta, right? Difference in liability to refund. And what do you think taxpayer A did with his tax savings? He was full gung-ho with this, by the way. He said, yeah, let's go ahead and do this. Did the cost seg. We have 355 grand carrying forward into 2022. So he knows that even if he doesn't purchase another property and does nothing else for the next 9.5 years, this $355,000 will carry forward and offset 33 grand in cash flow, basically allowing him to pay nothing in tax on 33 grand in cash flow for the next 9.5 years. So he knows he's already won. It's a beautiful position to be in. But taxpayer A doesn't want to work as a W-2 employee anymore. He wants to buy more real estate. So he takes this tax savings that he has, he throws it into a savings account with other monies that he saved up to buy more real estate. And in 2022, he buys another piece of real estate. So we not only have 355 grand carrying forward into 2022 from 2021, but he bought a new property in 2022, which we also cost segged in 2022. So I met with this client about 3-4 months ago, currently carrying forward into what we project into 2025, because we've already filed for 2023. We've already done planning for 2024. Carrying forward into 2025, taxpayer A has got about $740,000 in unallowed passive loss carry forwards, which his properties are cash flowing very nicely. And basically for the next, I think we calculated at about 12 or 13 years, if he didn't buy any more real estate, he pays nothing in income tax, federal or state, on all of that cash flow on his property portfolio for the next 12 to 13 years. He is that much closer to leaving his LADWP retirement, right? Because imagine that, imagine having 60, 70, 80 plus $1,000 in cash flow every single year. You're not paying a single dime of tax on it. Well, you know, in California, it might be difficult to live off 70, 80 grand in tax-free revenue, you know, depending on where you live. I know in LA, median household income is like 200 grand, and that's 2 LA Unified School District teachers making 100 grand each. And they still aren't able to afford to buy a home in LA County. That's how crazy it is in some parts of California. But 80 grand in Palmdale and Lancaster, where he is from, that provides him a pretty nice life. And he's not commuting, or he's not going to commute from Lancaster down to LA and work at LADWP anymore. He's going to have his great pension. So we're setting him up for success and early retirement by doing this, simply by applying a part of the code that a lot of people think don't apply to them, because they aren't real estate professionals or they make too much. Just understand that everybody's scenario is different. So have a tax consultant map this out for you. If it applies, great, we'll go ahead and move forward with it. If it doesn't, it still might make sense to elect the cost seg and just have that massive loss carrying forward into future years to offset cash flow once the property does come into the green, or when you retire and you no longer have active earned income, we flip you in retirement to being an active real estate professional. Because at that point in retirement, you have no earned income. You just have your retirement income and your Social Security income. That's all unearned income. So a majority of real estate professionals are actually real estate professionals that just are living in retirement, and that's really their only job, right? Because they have nothing else in earned income. Great conversation to have, great topic of conversation when you meet with a tax advisor here at Robert Hall or wherever else you decide to go. Make sure that you work with people who understand these parts of the Internal Revenue Code and these special elections. It could save you, once again, tens of thousands of dollars, especially if you're a real estate professional. I've seen it save. I had a real estate professional client in 2022 or 2023? 2022 or 2023, when the bonus depreciation was 100%. It saved this real estate professional client who had massive cash flow and massive commission income on a joint tax return. Both the husband and wife are real estate professionals. Ended up saving them like $375,000 in federal and state income tax. So it depends, right? In this case, it saved him 14 grand because he's not a real estate professional. But in a higher income bracket, if you are a real estate professional, it could save you literally hundreds of thousands of dollars in unnecessary tax. Okay, deductibility of mortgage interest and how much does it really save you? Understand that there's a limit on how much mortgage interest you can write off if it is your primary residence. If you purchased a property after December 15th of 2017, you are only allowed the mortgage interest on the first $750,000 of acquisition debt. So there's a heavy limit. And here in California, there's a lot of homes with mortgages over 750 grand. Elsewhere in the US, outside of New York, California, and Hawaii, we'll throw in Hawaii in there, the rest of the US, the other 47 states, there's a lot of mortgages that aren't above 750,000. So this limitation doesn't really apply to them, but it impacts California homeowners and New York homeowners and Hawaii homeowners more than any other state. So you have to be aware that it's not the Wild West. When you bring your 1098 mortgage interest statement to your tax advisor, it's not as simple as just pulling the number off the 1098, plugging it in, and saving you all this money. We have to take a calculation of that 1098, a percentage of that 1098 mortgage interest write-off, and make sure that we're limiting it to the first $750,000 of acquisition debt. For instance, if you have a $2 million first position loan on your primary residence, we have to take $750,000 divided by 2 million, whatever that percentage is, we multiply that times the mortgage interest that you paid during the calendar year. That is the federal deductible amount. Every dollar above that, not a tax write-off. On California's return, it's different. California never conformed to the $750,000 limitation. They allow you the interest write-off on the first $1 million of acquisition debt. So you also have to work with a tax advisor who understands that, sure, there is a limit on the federal side and there's a limit on the state side, but the state still allows you a little bit more of an interest write-off, and there's a box on your return to put the adjustment to allow you for the larger write-off on the state return. That's if it's a primary residence or a second personal residence, not a rental property. What happens if I take a home that I live in, or if I take a second personal residence and I turn it into a rental property? Is there a limit to how much I can write off in mortgage interest and property taxes? No, because it's a business, right? So if I have a $2 million loan on a fourplex, right, and it's bringing in rental income, and I've got the mortgage payments, got the property taxes, improvements, insurance, and I'm paying, let's say, $120,000 of interest on that $2 million loan per year, that's a $120,000 interest expense write-off against my cash flow, because there is no limit if it's a business. If it's a primary residence or a second personal home and you're not renting it out, you got to make sure that you're limiting the interest deduction on your Schedule A, which is where your interest deduction is reported on your tax return. As we approach year end, there's going to be a lot of questions about how much I can defer into my retirement plan. Are there options for me to invest in other things outside of the US stock market? Because the stock market seems to be ebbing and flowing. Just today, I'm looking at my brokerage account and thinking, what is going on? Well, it's an election year. Head on a swivel. I'm not going to sell off any of my positions. I'm going to hold, because that's what it does. It ebbs and flows. But I also know that if I have my retirement account set up as a self-directed retirement account, whether it's a solo 401k or a self-directed IRA, that I can have my stock investments as well as real estate investments and business acquisition investments, syndicated real estate investments, ATM business investments, all grouped into my self-directed retirement account. Self-directed retirement investing has been around since the early 70s. A lot of people didn't realize that you can take an old 401k with Northrop Grumman, with Walmart, and if they're not returning you great ROI within that retirement account, take that money, roll it into a solo 401k or a self-directed IRA, and start diversifying the funds into other things. Still have your stock investments in your NVIDIAs and your Google and your Microsoft, all of that stuff. Sure, have that investment, but then take some of that money that really wasn't returning you great ROI and maybe do gap funding for people who are flipping properties, maybe acquire a rental property, and now all of the cash flow that you're making on that rental investment is going right back into your retirement account, and it's tax, not tax-free, but it's tax deferred, right? If it's a Roth solo 401k, or if it's a Roth self-directed IRA, sure, it's all tax-free because Roth accounts grow tax-free. Now, all of a sudden, I can invest in things that I believe in, that I know how to deal with, that I know how to manage myself, right? So I'll have my stock investments, I'll have some real estate investments, I'll invest in some syndicated investments, maybe an ATM business, or maybe some real estate syndicated investments, and maybe a couple friends want to start flipping property, so I'll give them a $50,000 short-term loan, and I'll collect a point or some interest on the back end once they pay it back. All of that money is tax-free or tax deferred, sorry, not tax-free, but tax deferred because it is an investment within my self-directed retirement account. If you have just a traditional 401k, you're stuck with stock investments. You have a traditional IRA, stuck with stock investments. So understand that there are options for you in retirement to diversify your portfolio within the retirement account. I have a lot of clients saying, oh, I've got 4 or 5 401ks and IRAs sitting out there. Like I wish there was a way to consolidate. Perfect time to consolidate. Unless you have crazy ROI in your retirement account where you work for Netflix and you've got super low basis in Netflix stock, sure, maybe not touch that, right? Because that's something that is long-term gonna create crazy ROI for you, and it's got low basis, and Netflix isn't going anywhere anytime soon, right? It'll ebb and flow, but it's a money maker, right? But if you have other IRAs and 401ks and you're tired of not knowing where your money is at, not knowing where your ROI is, consolidate. Take all of those other retirement accounts, roll them into a self-directed IRA or solo 401k. Now you have it all in one central location. You can have stock investments, real estate investments, short-term loans, so on and so forth. I think you get the picture, but this has been around for a long time, 1974. And you wouldn't imagine the amount of people I meet in my seminar circles that have never heard of self-directed retirement investing. One common referral and vendor that Marshall Reddick and Robert Hall and Associates uses is Dmitry Fomenchenko with Sense Financial. I do seminars with him. I've done in-person seminars and webinars with him. He services, I can't even count how many clients he has helped Robert Hall and Associates set up self-directed IRAs and solo 401ks for, but he is just an incredible wealth of knowledge. And if you haven't talked to Dmitry, if you haven't listened to a webinar of his with Sense Financial, I highly suggest that you hop on a webinar. Maybe Marshall Reddick will have him on the calendar in upcoming months.
We just finished up with him, yeah. We had an excellent presentation about two weeks ago where I presented with Brett. And I mean, always a pleasure.
A wealth of knowledge. And once again, I'm all about options, right? Because a lot of people, when they think about tax planning and year-end planning, they think, oh, that's stressful. I don't really want to know. I procrastinate, so on and so forth. But if you don't do planning, you won't have any options. Because once December 31st passes, yeah, there are a couple tricks of the trade that we know how to apply, but a majority of those tricks of the trade and those strategies have to be implemented prior to December 31st. So just be aware of that, okay?
Hey, Tony, you want to take some time to answer a couple of questions that have come in?
Sure.
We got a couple rolling in here, so just give me one sec here. So one of our attendees is asking, how much does it cost to have a cost segregation analysis done?
Well, it depends. If you have the property held in an entity, it could be a couple $1,000s for a cost seg analysis. I just had a client who has 7 partnerships, all LLCs out of Delaware, but then they're also registered in Texas where my client lives. And so his cost seg for 7 partnerships ended up being, I think, like 12 or 13 grand. Now he makes really good money. So for him, the amount of tax that he saved by doing the cost seg, it was like almost 20x what the cost was for him. So, it could be very expensive depending on how many entities you have and if the properties are actually titled under the entities. If you just have one property individually owned under your personal name, I think GTG Consulting charges in between $1,000 and $1,500 for the cost seg election. That's if you own the property personally, it's not held under an entity. And then the tax preparation fees range, because if you own it individually, cost seg, I think if you own it on the individual side for a Schedule E investment, I want to say it's like $600 for preparing the tax return side of things. If you hold it under an entity, Robert Hall and Associates charges $2,500 per entity for cost seg. So it's 13 grand with GTG Consulting, another $2,500 to prepare it. And it's not as simple as you might think it is, right? It's not just simply plugging in a number as a deduction and running to the hills with all the tax savings. There are a number of things that play in here. It's a massive puzzle, and we have to put all the pieces together. The depreciation schedules have to be broken down per line item of 20-year, 15-year, 10-year, 7-year, and 5-year property. So we have to take all of the building that you have, which is one number, and we have to break it down in the cost seg analysis to what is 20-year and shorter depreciation lifespan CapEx improvements per line item. It's not just saying, okay, well, this is all 20-year, let's group it into one number. Here's 15-year, let's group it into one number. We have to break down the cabinets, the countertops, the piping, the electrical outlets, and anything that's under 20 years on the depreciation schedule can be accelerated. Then we have to make the 481A adjustment on the Schedule E. Then we have to file the 3115 change of accounting method election with the government stating that, hey, we are no longer waiting 27 and a half years for this depreciation. We're taking $300,000, $400,000, $500,000+ of depreciation, and we're accelerating it all in 1 year. So, you know, that $2,500 covers a lot, and it might seem very easy when you see us do it, but it's because we do a lot of them. So, but the cost it can be pretty costly depending on how you hold title and the size of the cost seg election or analysis.
Yeah, absolutely. Kind of similar one is there a threshold amount below which cost segregation is not worth it? You kind of touched on it a little bit.
It depends. It really depends. There is no income threshold where it doesn't apply. It just depends on, one, if you're a real estate professional, two, if you're married and your spouse can be a real estate professional or an active participant. It matters on your AGI. If you are not a real estate professional and you're making over 150,000 AGI, it's not that you're not allowed the deduction, you just aren't able to use it in this year. So you don't lose it, you just don't use it. It carries forward and offsets future cash flow. But as far as an income threshold to where it makes sense to do it and not make sense to do it, I would have to take a look at the tax return. I just don't feel comfortable giving you an income threshold because I just don't know. I don't know without seeing the tax return.
Yeah, so this is a perfect situation where you guys can connect with Tony and schedule these consultations. We have a couple more, but I'll just take some time to have you answer just one more that came in here. And then we'll kind of refer the rest to a consultation because we're running short on time here. What is the importance of opening an LLC when holding real estate and being a real estate professional?
Yeah, I mean, LLCs save you nothing in income tax. So just understand that when somebody comes to you and tells you that you need an LLC for a property, it's not like setting up the LLC is going to get you to pay nothing in tax. LLCs are only for liability protection. It does not save you it doesn't even save you an additional penny in federal or state income tax. It is solely for limiting liability on your property and allowing you to separate the risks and liability of the rental property from all of the personal risks and liability you carry on a day-to-day basis. So asset separation equals asset protection and vice versa. But LLCs are important, especially if you have significant equity in the property. If it's got great cash flow, you just need to be aware of all of that.
Yeah, thank you. We have such active listeners. We'll circle back to maybe 3-4 questions at the end of the webinar as well.
Sure.
Yeah.
So QBI, just wanted to mention this. It's been around since 2018. Just make sure that through year-end planning, you're dropping your taxable income below $364,200 if you're married filing joint, if it's possible, and $182,100 if you're single or head of household, just to qualify yourself for 20% of your real estate cash flow tax-free. I'm sure that you've all heard of QBI before. Most tax softwares auto-calculate this for you, but you do want to make sure that you're maximizing that QBI benefit as much as possible. If you're sitting right above this threshold, but there you have the ability to maximize deferred comp into retirement, go out and buy a company vehicle, make improvements to your properties before year end to reduce your taxable income, all of a sudden you're dropping into a bracket where 20% of your cash flow is now tax-free. So just be aware of that, okay? We're getting pretty close to the end here. The importance of basis, I didn't really want to include this tonight, and to tell you the truth, it's probably, once again, another hour conversation just in itself. I've had a lot of people wanting to invest in real estate syndications, and the whole pitch on the real estate syndication side is that, hey, give us $100,000, you'll buy into a 100 property portfolio, we're going to do cost seg, which this is then going to pass through losses to the individual investors. Well, understand that if you don't have enough basis in that investment, and let's say you get a K1 from this real estate syndication that shows $100,000 loss. Well, sure, it sounds great in theory to take a $100,000 loss, but the federal government says if you don't have basis in that investment above $100,000, you won't be allowed the $100,000 loss adjustment to offset your income. So one, you have to have enough recourse debt in the investment to actually cover the $100,000 loss, or you individually would have had to put enough cash into the investment, capital infusion, to cover that loss. And here's even a larger kicker. If that K1 has checked you as a limited partner, not a general partner, but a limited partner, that loss becomes a passive loss, and it's subject to passive loss limitations. And so once again, you got to be careful with what you're sold on. Before you give a syndicator money, before you hand over $100,000, $200,000, $300,000 check, make sure you take that portfolio, that information to your tax consultant and have us take a look at it to make sure that we can make non-passive elections to it. Make sure that your basis is high enough to allow these losses to offset income. Because like I said, the sale pitch on the syndication side is it's a great tax shelter, and in the long term, it will make you money. Well, sure, in the long term, it might make you money, but as far as it being an immediate tax shelter or tax savings benefit, that might not be true. Okay, so basis calculation is very complicated. It's incredibly important, especially for the individuals who are investing in real estate syndication. And that's why basis information is important. We need to take a look at that prior to you handing over a lot of money to a real estate syndicator. Okay. So once again, we're at the tail end. We do offer free consultations. If you want to sign up for a free consultation with any of our senior consultants, shoot an email to my email, TonyWatson@roberthalltaxes.com. I'll get you connected with Boyan, who's our new client intake. We'll get you on the calendar prior to year end, and we'll get you all set up with any questions that you have. Put a plan in place prior to the end of the year to hopefully not see surprises come tax time, right? Come tax season. So that's the main goal. That's it on my end though. So
Tony, thank you so much. I mean, we're so privileged and blessed to be partnered up with the best of the best to really give our clients all of this helpful information as it helps them in the long term, either month to month or year to year basis. It's incredible. The way you go into detail is awesome. And I know we can sit and do this webinar for 3, 4, 5 hours. We don't have all that time, but that's where the consultation comes in. Tony mentioned some of the senior advisors that you'd be able to schedule with. As far as Marshall Reddick's scope is concerned, what you can expect from a consultation with a Marshall Reddick advisor, whether it would be myself or some of the other advisors on the team, is we'll go over your goal setting. We'll evaluate options. We'll go into details on what we have to offer. We'll talk about time frame and kind of your timing on all these options. We'll set your criteria. We'll go through our markets, and then we'll introduce you to all the key players. An example of one of these key players is Tony here on the webinar today. This is a huge part of how we are successful and how we can refer our clients over to vendors to ultimately make the best decisions possible and strategize this. We have a fantastic property rating ebook that is kind of like the Marshall Reddick Bible here. It goes into detail on how we identify property classes where cash flow is more apparent, where appreciation is more apparent. I would highly recommend you can download it directly from our website listed right there at the bottom and read into it. If you have questions, again, we can schedule a consultation where we can go into this ebook and really break it down. Please look us up. Like Tony Watson and Robert Hall, we also have fantastic reviews, and they are all conveniently listed online and on our website. So please feel free to see what our customers are saying, what our clients are saying. It's a good way to gauge where we stand in the market. Again, we want to thank everybody so much for joining this evening. I know we had the Dodger game on, so hopefully you were able to focus in without looking on. I don't know. I got to check the score here. I know you're eager to check it, Tony, as well.
I'm eager, man. I hear cheering in my office down the hall. So I don't know if that's cheering. We have Yankee and Dodger fans in our office, so I don't know who they were cheering for.
I know. We had a couple more questions come in. I'm going to take time to maybe answer 2 of them that came in here, and then we'll kind of step in, and we're always happy to schedule a phone call to go in depth with everything. So, Tony, they're asking what percentage is the tax recapture when sold? What percentage is the tax recapture when you sold the cost segregation property?
Yeah, on depreciation recapture, it's about 25%. So
25%.
that's when you sell a property and you don't do a 1031 exchange, you're going to have the capital gain and you're going to have the recapture depreciation. Cap gain is a different tax rate, but all of the depreciation from cost seg that you've taken over the past 10, 15, 20 plus years, that is taxed at ordinary income tax rates at about 25%. So this cost seg and 1031 exchanges, man, that's a combined conversation there. You do not want to dispose of property that you've recently done cost seg on, because the tax liability will not only be the capital gain, but it will also be this massive recapture depreciation tax. Once again, depreciation recapture at about 25%.
Wonderful. And then this one is an interesting one. How accessible are you both by phone? I'm pretty accessible. You can reach me. I know Tony.
I mean, full transparency, like you call my office, you set up an appointment, but if you call in and need to speak with me right now, I'm going to be with all of you. I'm going to be with clients. So the best thing to do is call the office and schedule a time to speak. Yeah.
Same. Yeah. Wonderful. Well, we thank you again, everyone, for logging on to tonight's webinar. I'm sorry we couldn't get to everybody's questions. Again, we are super willing to schedule a consultation where we can go into detail on everything that we covered tonight. Thanks everyone again so much. Have a great evening, and we look forward to seeing you at the next event. All right, everybody. Thank you very much.